Hello, welcome to video 3. This is ACCA P1. This is now on agency theory and costs. First, we've got to understand what this is about. So let's just take some key terms. The directors manage the business on behalf of the shareholders. So directors are therefore agents of the shareholders, who are called the principal. Okay, so you've got directors acting on behalf of shareholders, because shareholders, they own shares, but they can't actually have access to books and records and make decisions about the company. That's what they delegated to directors to do. That's their role in life. So this agency theory talks about the relationship between the two, the agent, who is a director, and the principal, who's a shareholder. As it says in the notes in front of you, if you think of a large business like Coca-Cola, no way can all those shareholders have all the information available to them that directors get. Just not practical commercial sense. Because don't forget, a shareholder could easily be for somebody who acts for a rival company, who works for them. So you clearly need to split the relationship. That, unfortunately, though, creates problems. The agency problem arises because of different self-interests. The principal wants to minimize costs and risk. The agent, the director, wants to maximize their own remuneration, their own career advancement, their own bonuses and structures and share and status. Those two things therefore are an opposing force. You can't, for instance, minimize the cost entirely when you've got agents, directors wanting to maximize their own remuneration. So that's clearly going to oppose each other and causes problems. So this is the agency theory. Agency costs are obviously the director's remuneration itself, how you pay them, bonuses, incentives, cars, benefits, pension, all that is a cost of allowing the agent to take over your business. If you have an internal audit department, which large complex organisations do, that is a cost. They're there to make sure that things don't go missing. Things are looked after satisfactorily. Don't forget, it's not just about finance and fraud, it's just reporting the business. Don't forget, large complex businesses go across the world. Therefore, you need to have an audit department, internal, looking at reporting service lines across businesses. Is it doing it for the cheapest cost, the most profit? Are things working accordingly to budget? And clearly, finally, the external audit fee. So every time a listed company has its accounts signed off, there's an audit fee that goes with that. But basically, it's a chance for someone else to look at the accounting statements as prepared by the directors, who probably get bonuses based on those accounts. So clearly, it would be in their interest to make the results look better than perhaps they should be. So an external audit fee is paid to make sure those accounts are in compliance with law and accounting standards. Transaction cost theory is something that explains why companies exist. If you think of stakeholders in a company, i.e. customers, were trying to engage in the company's activities on their own, costs would be prohibitive. So the transaction cost looks at every transaction that is undertaken, how to maximize profit by minimizing cost. So the benefit of having a company doing something is you can engage on a bargaining power and learn how to do things your own way, as opposed to a customer who would struggle to work out how to get through something, and the cost would be prohibitive. As companies grow, however, agency costs tend to rise, basically because more and more headcount has to be put into place to get things to work, etc. So can actually work against you over time. Costs tend to rise because you then, as you get bigger, you have to have more monitoring, more internal controls, more processes to manage your business, to keep an eye on it as a shareholder, stakeholder. Transaction costs can be also increasing as you go international, across international boundaries. Political, economic, social, technological advances can initially increase before then decreasing. So it is a significant element of effectively agency theory, but it's a transaction cost theory, looking at individual transactions and the impact thereof. The link between the two is that transaction cost theory and agency theory are essentially the same issues and problems. Agency theory focuses on the individual agent, whereas transaction cost theory focuses on the individual transaction. Agency theory looks at the tendency of directors to act in their own best interests. Transaction cost theory considers that managers may arrange transactions in an opportunistic way. The corporate governance problem of transaction cost theory is, however, not the protection of ownership rights of shareholders, as is the agency theory focus, but rather the effective and efficient accomplishment of transactions by a company. The next theory I want to quickly make a start looking at is stakeholder theory. Stakeholder theory looks at basically everybody that could have an impact or be impacted by a corporate entity. So as it says here, it's any person, group of people or company that may be affected by the activities of an organisation. So pretty much anybody or everybody. In the old days, if you like, it was stakeholders were only shareholders, but then it's realised that no, actually there are other people interested, partly because stakeholders can easily come into conflict with each other. Some people will want one thing, some want another. So Johnson and Scholes, two academics, looked at this in more depth, and what they came up with was the ICE mnemonic, standing for internal, connected and external, and he defined it accordingly. Okay, so within the business are the internal stakeholders. If you're connected, however, but not internal, you're outside the business itself. If you're external, you're affected by the business, but only remotely or non-financially. So internal down to external via connected in the middle. Unfortunately, in the exams, it can be looked at and carved up many different ways. Don't be put off by that. They are one and the same thing. So if you talk about internal and connected, may be referred to as narrow and wider. Don't worry about it, it's the same terminology. There's lots of different ways of carving up this particular area of what stakeholders are. Okay. So, how well are the directors identifying stakeholders and prioritising the conflict? What the examiner quite often does is he'll paint a scenario, and then you've got to identify how well they're doing, what are the issues, what's the practical issues of the question, and that's when you apply your knowledge. And how legitimate is a claim of any individual stakeholder. So again, another scenario might be painted and you've got to talk about it. An exam question had a football club moving into an area, into a new area, and the examiner asked about all the stakeholders and who had more rights and this, that and the other. So, you know, your knowledge does get applied in a practical situation. The examiner likes that. Okay, I'm going to end the chapter here, recording, and we'll move on to the next one shortly.